Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Hi, this is Ryan Detrick. Can anyone hear me? All right, good. Sounds like people can hear me. Sorry about the little delay there. I know there was supposed to be a little intro. I don't know if we're going to be able to do the intro or not. Maybe I'll just start talking here. Again, my name is Ryan Detrick. I work for Schaeffer's Investment Research. And today I'm going to talk about the importance of incorporating sentiment when trading ETFs. My dad said a fool with a plan can beat a genius with no plan. That's a quote that I really like to start most of my presentations with, and I think it really hammers home the investing world. Again, it's a quote by T-Boone Pickens, but it really hammers home what we're all trying to do, especially in the market that we have going on right now. You have to really know what you're trying to do. There's so much news out there, so much wild volatility. Just look at the last 15 minutes of today when the market sold off. We're going to bounce into the close. And you really have to have a plan. And that's why we're all here. We're all trying to get better and trying to learn what it is that makes us good traders, or at least better traders. And hopefully over the course of enough trades or enough investing to have a pretty nice nest egg when it's all said and done. Let's talk briefly about Schaeffer's. Schaeffer's Investment Research is the world's largest options newsletter. We have a website, schaeffersresearch.com. Bernie Schaeffer started the company about, I think it was 30 years ago this summer. And again, we've grown into the world's largest option newsletter. I've been with Schaeffer's for about 8 years now. And on our website, we have a large editorial staff, and we definitely focus on option activity and overall market sentiment very closely. But on our website, we definitely follow the overall market, overall trends. Our website's totally free. You get a lot of good trading ideas there, again, based on, as I'm going to talk for the next 45 minutes or so, based on option sentiment, overall sentiment coupled with price action. So I'd invite you to check out our website when you have free time. The wisdom of the Great Sanhedrin. The Great Sanhedrin was a council of more than 70 judges during the time of Jerusalem, about 2,000 years ago. And what's neat about this is every day, except for the holy days, the council would get together and they'd vote on various issues in the land. And what really stands out to me and puts them ahead of their time is if all 72 judges were to agree on something, they would immediately throw it out. Now think about that, because usually when there's a large consensus, everyone agrees on it, it makes you feel comfortable. At the same time, by the time everyone agrees on something, there's a good chance that trend is probably over. And that really hammers home how we try to trade here at Schaeffer's. We're looking to go opposite the trend. Once everyone agrees on something, that very well could be the time that you not necessarily want to get out, but definitely be very close or have one foot out the door. Now to fill that in a little bit more, expectational analysis. Again, this is what Bernie Schaeffer has been working on for more than 30 years now, and it's kind of our overall methodology. You can see there's 3 parts there: fundamentals, technicals, and sentiment. And lots of different traders trade based on fundamentals, lots trade on technicals, probably even more definitely trade on fundamentals and technicals. Now to us, we think it's very important to actually incorporate sentiment also. Let's say you do a trade a week, or 50 trades a year. We think, definitely a lot of traders have made a lot of money on fundamentals and technicals. To us, if you also incorporate sentiment over enough trades, again, say 50 trades over the course of a year, that'll just help your overall gains just that much more and make you that much more profitable over enough trades. just talk briefly on some of these and what we look for. Fundamentals, everyone pretty much knows what that means. What we look for is earnings growth. Definitely we like to play the sectors that show very strong earnings growth. Now, when you talk about the market today, as we all know, the economy is without question slowing down. I don't think we're in a recession yet. Look at today's durable goods numbers. They were weak, but they weren't horrible. Now, the market's pricing, I think you could say, at a recession with some of the PE ratios we're seeing near the March 09 lows. Nonetheless, I don't think we're quite in a recession yet. But again, what we're looking for with earnings growth is some of those explosive names. I like to trade some of the investor business daily names, IBD names. Those are obviously strong fundamentals and good growing technicals also. Dividends, as a shorter-term trader like myself, especially focusing on options, dividends don't really play into it. But as we all know, most fundamental traders like to play based on dividends. Earnings revisions, one of my favorite types of trades is some type of exactly that earnings revision where a company comes out and either ups guidance or lowers guidance. So you have kind of what we like to call an event behind the actual trade. And definitely there's times when that can be a really nice driver for shorter-term trades. Yeah, it jumps up the initial day, but a lot of times that revision can lead to a lot more price movement in that direction over the coming days and coming weeks, and we like to trade that way. Next, new product, new management. Just look at today with Amazon. Amazon came out with their new Kindle. Kindle Touch, I believe it was called. I believe they come out with a couple of different ones. But nonetheless, the Dow sells off almost 200 points, and at one point Amazon was up $10 today. Finished up pretty strong, up more than 2%. So again, that's a nice fundamental driver. And we all know Apple's the ultimate here with just about anything they do. That can be a nice fundamental driver for a nice overall trend. But Amazon's a name we like, and we think that this new product, along with some other things they have going on, is a name that the market holds up very well, should break out the new highs relatively soon. Lastly, supply-demand. This, as we know, usually is in the commodity world more than anything. You talk gold and silver, obviously they're, I don't know if we call them correcting anymore, they're almost crashing at this point, but the supply and demand is more fundamental, but that's also longer term. I would consider myself more of a shorter term trader, so something I focus on, but for short term trade it doesn't really matter as much for me. Technicals, again, we all look at charts and price action. I have my chartered market technician, it's a CMT, which is just a designation that it's kind of like a CFA. It's what the CFA is to fundamentals, the CMT is to technicals. And simply you're looking at past price action to determine future movements. Things we all focus on, moving averages, gaps, volume, and definitely relative strength, or relative strength as a laggard also are things we like to see. Now sentiment, this is again the third leg to our overall methodology. There's definitely different things you can look at when it comes to sentiment. Some of the some of the more common ones we follow. Put the call ratios. Again, we focus on options. Puts usually are bearish bets, calls are bullish bets, and when you see a lot of bearish bets relative to the bullish bets, that tells you something. That tells you the crowd's betting against that name. If you have some strong price action in the face of some negativity in the options market, that can be very bullish as those names continue to unwind. I got an example here in a second where I kind of show that. Short interest, we definitely like to play names that have a lot of short interest on them. We found, more importantly, it's kind of the direction of the overall trend of short interest. You look at some of the financials, we are very bearish financials and have been for a while. Yet short interest continues to increase. And we kind of like that. They're going down, short interest is increasing, so we think a lot of volatility can come from that. But also, overall, the shorts are clearly in control, and they're not really covering their bets yet. So that's something you want to pay attention to is the direction of short interest. Analyst ratings. Analyst ratings are something we like to use. When we look, let's see what a good example is utilities. Utilities have held up very, very well. Yet, if you look at the analyst buy to hold ratings on the group, it's very low. There's some buys, some holds, and some sells. Most groups have a lot of buys and holds, but the group is overall, or analysts are overall bearish. Now, to us, strong price action like utilities have had in the face of analyst ratings that are rather neutral to bearish, that's bullish for that group, and that can lead to some upgrades, and we definitely like to see that from a sentiment point of view. And lastly, and this one's tougher to gauge, anecdotal sentiment. What I mean by this is kind of what you see when you turn on TV, what you see when you're looking at magazine covers. This one definitely takes time and a lot of practice to get good at, but it can definitely be extremely powerful. We all know, there's famous magazine covers at various peaks when everyone's bearish, put in a magazine cover. That's kind of how bottoms form. Also, when there's too much optimism, and that's more anecdotal sentiment. So clearly, right now, there's a lot of negativity out there, and we know that. A lot of bearishness, rightfully so. But, price action kind of wishy-washy. So what's important as a trader, for me, is that negativity. We have it, so it's good. Well, we want to see some positive price action that shows, you can finally get a strong rally, and we're not quite seeing it, in my opinion, yet. Think like a cinematician. Cheap can always become cheaper. Best example, obviously, the financial stocks back during the financial crisis. The XLF, the large financial ETF, dropped, I believe, 89% from peak to bottom, and all the way down. For the most part, we heard a lot of different people hammering home, these are fundamental good values, and they very well might have been. But again, when you have weak price action and people telling you these are good values, these are good buys, that's just a group that we don't think we want to touch. It sounds like, kind of the old catch a falling knife. We want to go long something or be bullish something that has extreme skepticism, but also that positive price action. So as long as people like it, and it's going down, that's a group we'd avoid, or more specifically, fast forward to right now, we look at financials, we just still think these names probably have a long way to go. We actually played a long way to go lower. We actually played some more puts. We've done very well playing puts on these names, and Bank of America, we just added some more puts yesterday, and looking at doing some more Citigroup. We just think there's too much optimism on these names going lower, and as long as we keep seeing that, we expect lower prices. Look for stocks with core ETFs that have low expectations, therefore avoiding the crowd. Low expectations translate into potential buying power. Again, that's kind of what we talked about earlier. And then lastly, success comes from buying low expectations, not low prices. That's very powerful. You think about it, that's not how a lot of people look at the market. Not saying it's right or wrong, but it's just the way we look at it. And after working here long enough, I have definitely seen it work consistently. So, if everyone loves something and it keeps going down, those are low prices, but that doesn't mean you should jump in, I don't think. Here's an example. The daily chart of potash, the fertilizer company. You can see here, when did I trade this? It was in July, right at the end of July, right before the market really tanked. But what happened, you can see the chart here. Now let's look at the drivers. They had earnings, and again, I mentioned earlier, I love to trade around earnings, either pre-earnings or usually post-earnings. But they reported, quote-unquote, great earnings. Stock was higher, eventually reversed lower. And you can see here another bullet point, found trouble at the top of the range. You just kind of look at the chart there. 62-ish definitely was an area of some potential resistance. Now, what I like here, we noticed substantial call buying ahead of earnings. And again, call buying are bullish bets. So when I see, a day or two ahead of earnings, a lot of bullish bets coming in, I kind of mark that down. I say, okay, well, here's a stock that's top of the range. Yeah, a lot of people expect good things. Now, the earnings came out, and they were good, but quickly the shares reversed lower. And something else we liked was out of the money call buying. So kind of speculative, kind of more aggressive call buying. And again, that says there's a lot of optimism. Should the price action start to disappoint, there could be a lot of upset people in the near term who could flip around and sell. Lastly, and I'll talk about this one as we get into it later, but we've got something called the Schaeffer Volatility Scorecard. It's a proprietary indicator we use. And bottom line is it looks at how much a stock moves relative to how much the options are priced. And this came in very high. So in other words, this is a very volatile stock. We don't think options are priced nearly as well as high as they should be. Therefore, that's something that I want to be playing. And again, it had a 96 out of 100. And I'll talk about this later, but that's a definite positive now. Let's talk a little bit more. Here's open interest. And again, these are just, the blue is calls, this is bullish, red is puts for August. You can see huge 60, that top blue line, or big blue line. Those are the 60 calls. And again, the stock, let's see, where was the stock? The stock was right around 59-ish, right around 60, some 62.50s there. So again, at the money, out of the money call activity. And then the earnings came out, it was higher, went a little bit lower. And lastly, you can see there's kind of where we got in, and clearly it had a downtrend. Now, let's not forget early August, everything went lower, so you could have played puts on anything, and, quote-unquote, had a good winner on it. But this one really hammered home, and it actually went down much more than the overall market did. And again, I think it's because of all that optimism in the face of the options market with disappointing reaction to earnings. It pays to keep it simple. This is an updated chart, or at least updated as of 2 days ago. And you can see it's just a long-term, I think 20 years, 20-year S&P 500 with the green line is a 20-month moving average. It's pretty simple. When the green line is going higher and the S&P is above it, probably want to be bullish. When the green line is rolled over, pointing lower, S&P is beneath it, you definitely want to lean to the bearish side. And as you can see now, we are currently flirting with breaking the 20-month. Now, everyone likes to be bullish, but as traders, we have to trade the overall trend. And unfortunately, there's definitely some things that I'm seeing that say the overall trend, we clearly had a big pullback, but there's some unfortunately things that say we might still be going lower here. Lastly, this is a little technical, but at the bottom indicator there is the MACD. And you can look that up, on Wikipedia or any websites. But you can see when it's green on a monthly chart, it's bullish. And as soon as it flips to red or negative, that's bearish time. And when you couple the MACD with that 20-month, you have two really nice indicators on a long-term basis. Now, what's happening right now, again, we're close to trading beneath the 20-month for the first time in a while. Also, that MACD histogram is about to go from green to red. So those are two definite negatives for the overall trend in the market, in my opinion. Magazine covers. These are definitely something we like to look at for the overall market and for this presentation for the ETFs to get a good sector feel of what's going on out there. Without question, the most famous magazine cover of all time is The Death of Equities that came out, I believe, 1979. Talked about how there's really no reason to own equities. And then, of course, we all know a short time later the market formed a major bottom and had a major 18-year bull market. So this is kind of exactly what you're looking for. Now, the important thing to know is this came out in late 79 or August of 79. The market didn't really bottom until 82. So everyone talks about this cover as being famous, yet it took a while for it to necessarily work. So that's kind of where we are now. I see so much negativity, yet the price action is still weak. So, maybe a year from now, there might be a major low, and then we can start to accumulate major shares again. But for the time being, price action is really what rules and what matters. But you have to be on warning if you start seeing a lot of negativity, and this cover clearly was a good example of that. Just for fun, we talk about the stock market, but there's mistakes all around the world in various sectors. Here's one Time magazine talking about Jay Leno's new 10 o'clock show. If you remember, he had the 10 o'clock slot. It says, if Leno's show works, said former NBC President Fred Silverman, it will be the most significant thing to happen in broadcast television in the last decade. So obviously a lot of you could say bullishness or optimism for this. And it says, Jay Leno with future television seriously. Look what happened. TV's 50 biggest bombs ever. Number one, Jay Leno at 10 o'clock. The Leno experiment is now considered the biggest bomb ever. So, it's kind of a fun little jab at entertainment there, but it hammers home again when you have a big consensus, and you have a little bit of a disappointment. I mean, his ratings weren't that bad at 10 o'clock, but there was so much optimism toward it. They didn't live up to the hype, and eventually worked his way back to his 11:35 slot. So, here's another example. Last summer, there was a lot of fear in Europe. It might sound like a rerun of right now. A lot of fear regarding the euro. There was actually more talk, I think, a year ago about more the fear of the overall survival of the euro, how it's just going to vanish. It was down 20% in 6 months, and if you look at a longer-term chart, it was 50% retracement of a decade-long bull market. There's this Bloomberg cover that came out last summer. Talking about the euro. Now, this one also, Canadian perk up Europe, The Economist. And interestingly enough, you started seeing these negative covers. The euro bottomed the exact same week as the cover. Here's the FXE. Early June formed a major low against extreme negativity toward the euro, and had a really nice rally over the next 5 months or so. Now, what I like about it is we are seeing very similar things to the euro right here. Here's a recent cover in September, how save the euro. Second one here, the decline and fall of Europe. So this is August now. Also, I just saw today the consensus report came out, and that's a poll looking at various traders and what they think of various assets. And the euro came extremely bearish, which isn't really a shock. It makes sense. So now we've got these negative covers, negative sentiment, and some very popular polls. So, the price action still isn't really there yet, but I think what I would say is definitely there's enough negativity in the mixture there for the euro to have a pretty good sized bounce should any positive news ever come out of Europe. And for a while now, at least 8 weeks, we haven't had really good news. But that's not to say, if it doesn't happen, the euro is ripe for a pretty good bounce, I think. But again, it all comes down to price action at this point, so just be patient and wait for some price action. Famous one that we did really well on back in '09, and again, this is a cover here talking about commercial real estate, deep trouble, why the commercial real estate crisis looks so scary. Off the March '09 lows, there was obviously a lot of negativity, but there was probably the most toward commercial real estate. And even in the midst from March '09 to when this cover came out in November, commercial real estate, mainly the IYR, the large ETF, was doing very, very well on a price action basis, yet you had this negative cover come out. So this is exactly what we look for. And again, you don't see these very often, so when they work out, it's obviously very nice, and you should take note. And they said, watch out for commercial real estate. So in 2010, commercial real estate was one of our most bullish sectors. And the main reason was it had a good '09, or the second half of '09, with a lot of negativity. In 2010, once again, commercial real estate did really, really well. So that's what you should be on the lookout for when you're trading ETFs and sectors. Magazine covers going contrary to the price action. Here's a neat one. Business Week, Amber Waves of Pain. Do not buy commodity ETFs. Do not buy commodity ETFs. Do not buy commodity ETFs. Sure enough, you can guess where this is going. You see something that dramatic, and here's again potash. That cover came out late last July. Soon after, potash had a tremendous jump higher on a buyout news. Also, here is the agricultural ETF, the DBA, Power Shares DB Multi-Sector Commodity Trust Agricultural Fund, around 25-ish. Soon after, it's above 30, just a couple months later. So, again, these are the things we're looking for when you see these covers like that. And this is a great example of one that worked, and if you played into it, you probably did pretty well for the remainder of the year playing a lot of these commodity names. 1950, the Monaco Grand Prix, Juan Manuel Fangio was a very famous race car driver. And this is a famous course because there's a tunnel you go under. And when you go under the tunnel, the light is perfect in a certain way. When you come up out of the tunnel, you really can't see much, or at least for a split second. So it's famous because there's a lot of spectacular crashes that occur. And what happened in 1950, he actually ended up winning this race, and the reason why, right before he went into the tunnel, he noticed all of the spectators were not watching him because he was the leader. He could tell out of the corner of his eye that the spectators, by the way their shirts looked, were actually looking up above, so up in front of him. So as he went into the tunnel, he actually slowed down, and because of that, there was an accident right outside the tunnel. He avoided the accident and went on to win the race, as numerous cars were caught up in this accident. So clearly, these other drivers didn't notice this. And he did, and as a reward, he won the race. And they talked to him afterward, and he just said, he didn't even necessarily notice at the time something in his body and his bones didn't feel right. He slowed down, and again, he missed the accident and went on to win. And it hammers home, I think, with trading also. George Soros is famous for just following his overall body. When his body aches and he has certain things wrong with him, he thinks his body's way of telling him something's wrong. You don't necessarily know what it is, but it maybe just tells you to get out of a certain position, or maybe have more of a certain position. But you really, it takes time. I mean, clearly, I've been doing this for almost 15 years, and there's still so much. You learn more and more every day that you clearly don't know as much as you thought you did, and you're always learning. That's what makes it fun. But at the same time, I've seen with Bernie, who's been doing this for a lot longer than I have, Bernie Schaeffer, my boss, certain calls he'll make that I don't really see, but again, it's just more of a gut feel. And that's where trading comes down. So much of this game is gut also. We try to make it simple. We try to make it automated. A lot of times you see 2 or 3 things you like. You just kind of have to go down with your gut. And this is a great example here during the Monaco Grand Prix as to what it really takes for gut. It just takes a lot of time and preparation and practice.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.